Well, the trade war probably won't have a material impact on the US or Chinese economies. It will need to escalate to a degree that we really just don't envisage before it begins to derail any major economies, although certain companies will be affected. What worries us is the political undercurrent. For years, the free movement of goods, capital and labour have allowed trade to grow and keep prices low. Today, this looks as if it's going into reverse. This could ultimately lead to a trend of climbing prices, and stocks and current valuations are very vulnerable to return to an inflationary environment, and this is something we're keeping a very close eye on. It is, I'm afraid, a worry. Well, forecasting currencies is really tricky. While a large part of the portfolios remain invested in pounds, we do have less invested in the UK than we normally might. The big uncertainty is Brexit and indeed the entire UK political outlook. Against this near-term threat, we need to weigh up against the growing risks in the US. Trump's policies are essentially an enormous gamble, and we fear that the US could end up in real problems over the medium term as a result. I think we may need to reassess our positioning in sterling around the turn of the year, though the situation is very fluid. Well, higher US interest rates reduce the supply of dollars around the world, and this tends to be a negative for emerging markets. Against this negative, we need to weigh against the positives of strong global growth and the attractive valuations available in many emerging markets. On balance, we still like emerging markets, although we are currently undertaking research to see whether there are some more specific opportunities within the region that we might be able to take advantage of. The political situation in Italy is a real mess, but this is kind of normal. The new government will create some challenges for the EU, but not ones that we believe will threaten the fabric of the Union. European exporters may be vulnerable to an escalation of the trade war with the US, but we think the main determinant of returns will be how the economy grows. At the beginning of the year, there were some very high expectations for European growth. These hopes have now drooped a little, and European assets have lagged slightly. Japan seems to be a slow burn situation. The growth outlook is unexciting, but by no means bad. Companies are gradually being run with a little more focus on shareholder returns, and valuations appear attractive relative to other developed markets. We like the stock market and have a little more invested here than we might normally have.